Hi, I'm Andrea. Welcome to today's Harper Lecture. The Harper Lecture series highlights the University of Chicago's collective commitment to the highest aspirations and standards in research and education. Today, you will hear from our world-class faculty and enjoy stimulating conversations on critical topics, all in the comfort of your home.
We extend our appreciation in advance to our global university community for their collective efforts in supporting the mission of the university in today's deeply challenging environment. Technology has allowed us to remain connected and engaged, and tonight, you too will be part of the conversations. A couple of notes. All participants will be muted. However, we do encourage you to ask questions. We will have plenty of time for questions at the end of the presentation. If you have issues with audio, you may want to shut down your programs running in the background or dial in from your phone.
Hi, I'm Colin. On behalf of everyone at the UChicago Alumni Office, we offer our deepest gratitude and appreciation for your continued support. We're proud to be part of this community as it has come together during these trying times to invest in our students, empower our faculty and scientists, and extend care and connection. And now it's my pleasure to welcome you to the 41st season of the University of Chicago's Harper Lecture Series. Thank you for being with us. Enjoy.
Hello, everyone, and welcome to today's Harper Lecture, Policy Options for Student Loans with Professor Constantine Yannelis. I'm Andrea Hodgman, Associate Director for Intellectual Engagement and Travel and the Program Manager for the Harper Lecture Series. On behalf of everyone at the UChicago Alumni Office, thank you for joining us. Please allow me to introduce our moderator. Amr Sufi is the Bruce Lindsay Professor of Economics and Public Policy at the University of Chicago Booth School of Business. He is also a research associate at the National Bureau of Economic Research. He serves as an associate editor for the American Economic Review, the Journal of Finance, and the Quarterly Journal of Economics. Professor Sufi was awarded the 2017 Fisher-Black Prize by the American Finance Association, given biannually to the top financial economic scholar under the age of 40. Professor Sufi's research focuses on finance and macroeconomics. His research on household debt and the economy forms the basis of his book, co-authored with Atif Mian, House of Debt, How They and You Caused the Great Recession and How We Can Prevent It from Happening Again, which was published by the University of Chicago Press in 2014. Professors Yannelis and Sufi, thank you for joining us. Professor Sufi, I'll hand things over to you.
Great. Well, thank you very much, Andrea. It's a great pleasure to be here tonight. I want to welcome everyone into the Harper Lecture. It's fantastic that so many of you could join us, and we really feel honored by your presence. I have the privilege of actually introducing Constantine Yannelis tonight, who's going to be giving us the lecture. One of the joys of being at the University of Chicago, and the reason I've been here my whole academic career, which is 15 years at this point, is that we really take research seriously. And when we look to hire new faculty, we look to hire faculty that are working on topics that are super important for the world. We don't just want research to be something in the atmosphere. We want it to be something about the real world, helping us to solve problems, helping us to make the world a better place. Constantine's research fits right into that category. He's got his PhD in economics in 2016 from Stanford. And after a brief stint at NYU, we were honored and privileged that he accepted an offer we made him, and he joined our faculty at the University of Chicago Booth School of Business in 2018. We really aggressively tried to hire Constantine because even then, this was 3 years ago, he was basically the world's leading scholar working on student debt. Student debt has become an incredibly important issue and for the United States and for many countries in the world. And so we were thrilled that we were able to get Constantine to come join our faculty. His research has been published in all the top journals. His research is covered widely in the financial press. And he also has a lot of real world experience. Before he got his PhD, he worked at the Federal Reserve Bank of Chicago. He also worked at the US Department of Treasury. So I'm just thrilled to have him here tonight to help us learn about this super important issue. And with that, I'm going to go ahead and hand off the floor to Constantine. Constantine, please take it away.
Thanks very much for introducing me, Amr, and the kind words. I really appreciate them, and it's a great honor to be here and to work with many of my idols in the profession. And thanks very much to everyone for coming out tonight to listen to me. I really appreciate everyone's attention. So I want to begin the night by saying that education is the highest single return investment that most Americans will make. Thus, getting our system of higher education financing right is of fundamental importance for American households and to the American economy. This is a tremendously complex issue, and tonight I want to present some basic facts about the student loan market, clear up some common misconceptions, and talk about different policy options. So a key takeaway should be that this is a nuanced problem, which requires nuanced policy solutions. In particular, there's a great deal of variety in the situations faced by borrowers and their problems. Student loans have increasingly received attention both in the media and among policymakers. A key reason for this is the size of the student loan market and its rapid growth. Student loan balances currently stand at 1.7 trillion and are the second largest source of household debt in the United States, following mortgages. To put that number in perspective, outstanding student loan balances are larger than the GDP of countries such as Brazil or Russia in 2021, large countries. This balance has grown rapidly over the past decades. This figure is showing using data from the New York Fed, various types of aggregate household debt balances normalized to 100 in 2003. The red line shows student loans. As we can see, there is a roughly sixfold increase in student loan balances during this time period when the data series begins. This rapid rise in relative terms far outpaces increases in other sources of household debt, even mortgages during the financial crisis. It also far outpaces increases in tuition or enrollment. Even the growth in mortgage balances, even though the aggregate balance is much larger, is much smaller in relative terms. So if tuition increases and enrollment growth can't explain this rise in loan balances, what does? There are a number of factors which I'm studying in ongoing research with Silva and Katarina at Wharton, but it turns out that the single largest one is effectively extending the term of loans. I will get back to this point later in the talk, but there exists a number of federal programs which allow students to delay or make smaller loan payments. This has led to students making smaller payments over a longer period of time. This means both larger loan balances and more borrowers currently in repayment. It is also not necessarily a bad thing if students can delay payments to later in life when their incomes are higher. So to some extent, it's still an open question whether this growth in and of itself is a cause for concern. Before I talk in detail about policy, I want to touch on why we have government student loans in the first place. So student loans are unlike any other consumer loan market in the United States, chiefly because the vast majority of student loans, over 90%, are either directly dispersed or guaranteed by the federal government. Whenever we have massive government intervention in markets, I think it's important to take a step back and think as economists about whether this intervention is warranted. Of course, this is Chicago after all, and we should think about the proper role of government versus the markets. In the case of student loans, there's a clear economic rationale for federal support. This comes from a role that government can have in alleviating credit constraints. If lenders, say banks, are unable to separate borrowers who will repay their loans from those that don't, credit provision may be inefficiently low. The basic idea here is that the lender will offer only one price to all borrowers. Borrowers likely to repay will be paying too much and hence may not borrow. This leaves only borrowers who do not repay their loans in the market and hence the lender may charge an even higher price, driving out more borrowers likely to repay, and perhaps even causing financial collapse. This idea was first shown in a seminal paper by Stiglitz and Weiss in 1981, and was applied to the student loan context by Mankiw in 1986. These papers also show that in this credit market with imperfect information, government intervention can help bring credit back to optimal levels. This can be done in the form of loan guarantees or interest rate subsidies. So there's a clear justification for government intervention in the student loan market, though we can debate how large this should be and how it should be administered. Why finance higher education through private payments and loans and not solely through grants or have taxpayer-financed higher education like in much of continental Europe? A key reason is equity. People who go to college earn more than those who don't, and people who spend more years in college, like JDs or MBAs, earn more than those who spend fewer years, like dropouts or associate degrees holders. Giving transfers to people who earn more over the life cycle is regressive, and thus the systems of higher education finance we see in English-speaking countries like the US, Australia, Canada, and the UK are actually much more progressive than fully taxpayer-funded systems like those in continental Europe, which give significant transfers to people earning high amounts over the life cycle. Of course, this does not mean that there should not be subsidies for higher education. There are strong reasons to subsidize certain fields of study or individuals stemming from externalities. The idea that higher education generally improves society. We as a society may want to subsidize people to go into basic science as creating innovation that others can build upon benefits everybody. If there are externalities in higher education, this is a reason to provide subsidies through grants, not loans. Loans are there to alleviate credit constraints. It is also important to point out reasons that are often pointed out as justifications for federal student loans or subsidies for education that are in fact fallacies and don't make a lot of sense. The argument is often made that education is a public good and thus should be provided by the government. A public good has a precise definition in economics. It is something that is non-rival and non-excludable. Non-excludable means that people can't be barred from using it, and non-rival means that someone using a good doesn't prevent someone else from using it. Clean air or beautiful architecture are examples of public goods. We can all enjoy marveling at the Rockefeller Chapel on the University of Chicago campus. Higher education is clearly both excludable and rivalrous. Students are routinely excluded from selective colleges by being denied admission, and if slots are limited through, for example, classroom space, attendance is also rivalrous. So if education is not a public good in an economic sense, even if there's a substantial role for government in providing education. There's a clear justification for government intervention in the student loan market, but the natural question that arises is how this intervention should be structured, and are there problems with the current system? The way the student loan program works is that students apply and are selected at colleges, and then loans are dispersed through college financial aid offices using funds directly dispersed by the Treasury. In the past, funds were dispersed by private banks and guaranteed by the government, meaning that if a student defaults, the government would reimburse lenders. After students leave college through graduation or dropping out, the loans are administered by private servicers, which have contracts with the government. Servicers are paid flat fees for each borrower that is current on their loan. Is this system working? In terms of economic efficiency, ultimately what we would want is that for all loans to be made where the return exceeds the cost of funds. By return, what I mean here is the increase in earnings coming from the investment in college. Measuring the returns to education is a notoriously difficult task, but my reading of the academic literature is that two things are clear. First, on average, the returns to education are quite high, and the typical person benefits from higher education. This is also generally folk wisdom. Most of us would encourage young people in most cases to go to college. But another finding is that there is heterogeneity in the returns to education. Not all students are doing well, and some success is predictable. A key point that has to be made whenever discussing student loans is that the outcomes of borrowers vary widely. It is undeniable that a significant number of borrowers are struggling and are sympathetic candidates for some kind of relief. One worrying indicator in the student loan market is default and delinquency. This figure shows data from the Federal Reserve Bank of New York showing delinquency rates over time for different types of household debt. Student debt is in red. Two patterns emerge. First, prior to the current COVID crisis and policy changes, student loans had the highest delinquency rate of any type of consumer loan. Second, delinquency rates have been growing over time. It turns out that much of this delinquency is predictable and associated with the types of colleges that students attend. This is a figure from one of my papers with Adam Looney, who is at the University of Utah now. The figure shows the fraction of a cohort defaulting within 2 years of entering repayment in 2001 and 2011 by types of institutions. What it shows is that loan default rates are strongly correlated with school selectivity. Selective schools and graduate programs have extremely low default rates. For-profit and two-year colleges have much higher default rates than other institution types. We see a very similar pattern if we turn to earnings. This figure shows earnings 2 years after graduation, again in 2001 and 2011. The majority of borrowers end up earning high amounts and do not have difficulty repaying their loans. A college education is, in the vast majority of cases in America, a ticket to success and a high-paying job. But at some institution types, this doesn't appear to be happening. A very large portion of borrowers who struggle attend a relatively small number of institutions, predominantly for-profit institutions, places like the University of Phoenix, Kaplan University, and DeVry. Well, what I am showing here is just raw data and shouldn't be interpreted as the value added of schools. At this point, there's quite a lot of research showing that the returns at for-profit colleges are at least lower or at least no higher than peer institution types, despite being more expensive. It turns out that the expansion and contraction of for-profit colleges explains most of the time series variation in student loan default, which in turn is driven by government policies expanding and contracting the supply of credit to these high default institutions. In another paper with Adam Looney, we show that almost all of the changes over time in defaults are driven by government policies that grow or shrink these for-profit colleges by changing access to student loans. We do a lot in the paper to show this and make precise quantitative statements about changes over time. But here I think that the time series graphical evidence is really quite compelling. The blue series shows the fraction of for-profit borrowers, while the red series shows the lagged fraction of students defaulting within 2 years of entering repayment. You can see that the fraction of students defaulting just looks like the fraction of for-profit students shifted. The upshot here is that we can address much of the default problem by focusing on a relatively small set of borrowers. We can also potentially address it by focusing on the underlying incentive structures which lead to bad outcomes for many students. The problem may not be with for-profit incentives per se, but simply with the way that incentives are currently structured. The core of the problem in the student loan market lies in a misalignment of incentives between students, schools, and the government. This misalignment comes from the fact that borrowers use government loans to pay tuition to schools. If borrowers end up getting poor jobs and they default on their loans, schools are not on the hook. Taxpayers end up paying the costs. Thus, the incentive for profit maximizing schools is to sign up students, get them to pay, and not necessarily be concerned with whether they repay the loan. Schools are very good at capturing government loans under the current system. They capture these loans by increasing tuition. This is a figure from the appendix of my study with Adam Looney, and it shows average borrowing right after government loan limits are increased. You can see across all school types when limits are raised in 2007 and 2008, there's a sharp increase in borrowing. There is today abundant research confirming the so-called Bennett hypothesis, named after the Secretary of Education in the 1980s, who suggested that colleges and universities capture federal student grants and loans. An excellent study by Luca Nadal and Shen in 2019 suggests that schools capture about a quarter of every dollar of federal loans by raising tuition, and that this proportion is much higher at for-profit colleges, close to 1 for 1. This incentive misalignment leads to profit maximization not necessarily being in the interest of students. This figure from one of my papers, which is joint with Charlie Eaton and my former colleague Sabrina Howell, uses Department of Education data. It shows the fraction of employees at universities in sales. As you can see, this fraction is very low at public universities, still quite low at private nonprofits, but much higher at for-profits, and particularly at private equity-backed for-profits. This is indicative of these schools focusing on signing students up who pay for college with government loans, regardless of whether they default or not. So they're spending more on sales relative to instruction or other activities. How do we address this incentive problem? There are many options, but first let me comment on the commonly proposed solution, universal loan forgiveness. One common proposal that is currently under consideration by policymakers is some form of blanket student loan cancellation. It is important to note that canceling student loans will not reduce the average debt of Americans. Rather, it will transfer private liabilities to the general public by increasing the federal debt. The long-run consequence will be an increase in taxes or a decrease in public spending. The immediate consequence is a redistribution of wealth within society. It is thus important to understand the distributional effects of student loan forgiveness. It turns out that this is an extremely regressive policy. It provides more assistance to higher income rather than lower income individuals. This is primarily because people who go to college tend to earn more than those who do not go to college, and people who spend more on their college education, like those who attend medical and law schools, tend to earn more than those who spent less on their college education, like dropouts or associate degrees holders. My own research, which is joint with Sylvain Catherine at the Wharton School of the University of Pennsylvania, shows that most of the benefits of a universal loan cancellation would accrue to high-income individuals. Individuals in the top 20% of the earnings distribution would receive 6 to 8 times as much debt relief as individuals in the bottom 20% of the earnings distribution. This figure is showing in blue balances by deciles of the income distribution. The rightmost blue bar is showing forgiveness for the highest income tenth of borrowers, while the leftmost blue bar is showing forgiveness for the lowest income tenth of borrowers. As you can see, high income borrowers receive much more forgiveness. The red bars show present values, and the line, the red line, shows the ratio of present values to balances. What are present values? Well, while loan balances are an intuitive starting point to think about the effects of loan cancellation, it paints an incomplete picture of who would reap the most in terms of the financial benefits of loan cancellation. This is because some individuals are already projected to see forgiveness under programs like public service loan forgiveness or income contingent loan repayment plans. In our recent working paper, we take this into account and construct present values of loans, meaning the value of what will actually be paid, taking into account when it will be paid. These are shown in red. We estimate that for the borrowers in the bottom fifth of the earnings distribution, forgiving $1 of debt reduces lifetime payments by less than 40 cents in present value terms. When this is accounted for, the financial benefits of loan forgiveness are more concentrated among high earners than the distribution of balances suggests. Erasing all federal student debts would benefit the top 10% of earners just as much as the bottom three deciles combined. So this policy is even more regressive than it appears at first glance. How is this possible? A point that is often missed is that there already exists a large loan forgiveness program for low-income borrowers. Nearly half of federal student loan debt is held by borrowers enrolled in income-driven repayment or IDR programs, a system already offering substantial relief to borrowers with modest earnings. It does this by indexing their payments to their discretionary income, defined as the share of their income above 150% of the poverty line. After 20 or 25 years, their remaining balances will be forgiven. How much borrowers enrolled in IDR would financially benefit from a debt jubilee is something disconnected from their outstanding balance. These basic patterns are still true for policies that limit forgiveness up to $10,000 or $50,000, which have been suggested as a way of making forgiveness more progressive. However, capping forgiveness amounts could in some cases actually lead to less progressivity. To see this, consider the fictitious case of two working moms, Laura and Tanya. I picked the names here from my favorite novel, Dr. Zhivago. They both have $50,000 in debt and are in IDR plans. So forgiving $50,000 would eliminate both of their debts entirely. What about forgiving $10,000? Well, let's look at both of their situations in income-driven repayment. So Laura is a single mom living with two kids, earning $50,000. Under the most recent IDR rules, her annual payments would not exceed $1,742, making some assumptions, assuming that interest rates are 4% and that she's 15 years away from forgiveness. Laura will only repay $19,400 in total, and the remaining debt will be forgiven. If forgiven balances are untaxed, it makes no difference whether her balance is $20,000 or $50,000. Importantly, forgiving $10,000 will not reduce her payment by a single cent if she owes more than $30,000. The reason being that her payments are determined by her income, and that this forgiveness is just for a balance that wouldn't be paid anyway. Now consider Tonya, a married mother of two who earns twice as much as Laura. She earns $100,000 annually. Tonya would pay $6,742 annually, and each dollar forgiven would reduce her lifetime payment by $1 if we forgive up to $10,000. Thus, Tonya, who earns twice as much as Laura, would benefit from the $10,000 in loan forgiveness, while Laura would not. This example illustrates two important points. First, who owes the debt is a very inaccurate proxy of the wealth transfers induced by student loan forgiveness. The present value of future payments is a better measure. Second, and counterintuitively, the benefits of partial forgiveness are even more concentrated at the top of the earnings distribution than broad cancellation because of the structure of many repayment plans. Another problem with capped student loan forgiveness is that many struggling borrowers will still face difficulties. A small number of borrowers have very large balances and very low incomes. Policies for giving $10,000 or $50,000 in debt will leave their significant problems unaddressed. While income phase-outs make forgiveness less regressive, it is a very blunt instrument and leads to many individuals who earn large amounts over their lives receiving substantial loan forgiveness, like medical residents or judicial clerks who will go on to earn high amounts in just a few years. If the goal of policymakers is to make sure that funds get into the hands of borrowers at the bottom of the income distribution in a progressive way, blanket student loan forgiveness does not accomplish this goal. Rather, the policy primarily benefits high earners. Some commentators have also pointed to student loan forgiveness as a way to lower racial inequality. The racial wealth gap is indeed a significant problem in the United States, and one of the most distressing failures of the federal loan program is the high default rates and significant loan burdens on Black borrowers. And student debt has been implicated as a contributor to the Black-white wealth gap. However, the data show that student debt is not a primary driver of the wealth gap, and student loan forgiveness would make little progress closing the gap, but at great expense. Forgiving all student loan debt would cost about 1.7 trillion and shrink the racial wealth gap by about 3%. Surely there are more effective ways to invest 1.7 trillion if the goal is to close the racial wealth gap, which is largely driven by differences in income and real estate values rather than student loan burdens. For example, this money could be invested in early childhood education. Another argument sometimes made for student loan forgiveness is that it will stimulate the economy by increasing consumption. This is a fallacy. Jason Furman, the chair of the former President Obama's Council of Economic Advisors, said, to paraphrase, that student debt forgiveness would have stimulative effects close to zero. He's right. Canceling student debt would simply transfer private liabilities to the general public by increasing the federal debt. Most of the forgiven payments would be far into the future, as would the additional tax payments needed to pay off additional public debt. Which effective future payments is larger is hard to determine, but the changes in payments would occur far into the future, making arguments about stimulus in the aftermath of a recession much less relevant. While student debt cancellation makes little sense from an equity perspective, as the benefits accrue to high-income borrowers, one possible reason to support student loan forgiveness is incentive effects. The argument is that student debt may be holding back individuals and depressing earnings through a debt overhang channel. This is perhaps the strongest argument for student loan cancellation, although the evidence here is quite mixed. The first paper to explore the effect of student loans on earnings, to my knowledge, is Rothstein and Roos in 2011. They exploit a no loans policy at one very selective elite US college. They aren't allowed to name the college in the paper, but think Princeton, Harvard, or Yale. They find that moving away from student loans actually leads to lower earnings. The basic argument that they make is that because of loan payments, students go and work for, say, Goldman Sachs instead of Greenpeace. In other words, they take higher paying jobs. Of course, students at very elite colleges may not be representative of the broader population, much less the average student loan borrower. A more recent and very nice study by Marco DiMaggio, Ankit Kalda, and Vincent Yao actually finds the precisely the opposite effect, that student debt depresses earnings. They use a very interesting and clever strategy focusing on private student loans and a company, National Collegiate, which owned loans but lost the chain of title. This led to some debts being discharged, but only for borrowers already in default. Since this was discharged only for loans already in default, I tend to think of their results as being similar to the effects of bankruptcy, and the effects may be different for federal loan borrowers and borrowers not in default who see their debt forgiven. I have a paper with Adam Eisen at the US Treasury and Serena Goodman at the Federal Reserve. We use the universe of federal student loan balances, everyone in the country, matched to IRS tax records, and a cutoff stemming from an individual's date of birth. There's some caveats to what we do. For example, because we look at older borrowers, we're disproportionately looking at older students who are at less selective schools, but we actually find a precisely estimated zero effect of student loan limits on earnings. So I think the takeaway from the research here on incentive effects and how student debt affects earnings is that there's a lot of heterogeneity. Some borrowers may see earnings increases, or decreases from discharging student debt. But there is still significant uncertainty, and this is an area where we need more research to understand how forgiveness would affect earnings. For the moment, the policy debate has been centered on balance reductions. One advantage of present value computations is their flexibility. They can be used to study alternative forgiveness policies, such as the expansion of income-driven repayment programs or an increase in their generosity. There are many more policy options rather than simply forgiving student debt or forgiving student debt up to a cap or an income threshold. Another option for providing relief to borrowers is expanding the use of income-driven repayment or IDR plans. One fact that is often missed is that this program already provides progressive forgiveness to many borrowers. The way that these programs work is that depending on the plan, borrowers pay 10 to 15% of their income above 150% of the poverty line. And then again, depending on the plan, after 20 to 25 years, remaining balances are forgiven. So thus, IDR is a progressive policy. Put simply, higher income people pay more and lower income people pay less. This also has the advantage of smoothing payments over time. To see this, you can look at this figure, which is from a joint paper with Holger Müller at NYU, which illustrates how payments work. This shows payments as a fraction of discretionary income for an individual who earns $40,000 right after college and who has a balance which amounts to a $300 monthly payment under a standard 10-year repayment plan. With some assumptions on earning growth and interest rates, we can calculate payments as a fraction of income under each plan. What you can see is that the IDR plan, which is in blue, allows borrowers to effectively smooth payments over time. They can also end up paying more over time, depending on interest and discount rates. But it's important to note that there's no prepayment penalty for student loans, so this is not a disadvantage. One of the chief advantages of IDR from the perspective of borrowers is that these plans provide insurance. Here we repeat the exercise for someone earning $30,000 right after college. As we can see, this borrower ends up paying almost nothing and most balances are forgiven. This figure is from a paper which is joint with Sylvain Catherine, and in it we simulate forgiveness under different options, expanding the generosity of IDR plans. In our paper, we estimate that increasing the IDR threshold from 1.5 to 3 times the poverty line would benefit the bottom third of borrowers more than forgiving up to $50,000 for all borrowers. So this is showing forgiveness in different deciles for different policy options. The dark blue line the dark blue bars are showing putting everyone who would benefit in IDR. The dark red bar is showing putting everyone in an IDR plan with 10-year forgiveness rather than 20 or 25-year forgiveness. And the light blue line is showing this plan, putting individuals in an IDR plan where you only start paying on income above 3 times the federal poverty line. So the bottom line here is that expanding the generosity of IDR plans could offer more dollars forgiven for low-income borrowers at a lower overall total cost. This is because expanding the generosity of IDR doesn't give forgiveness to high-income borrowers, unlike these untargeted options. If the goal of policymakers is to put dollars in the pockets of low-income individuals, this is a cheaper way of doing it. IDR plans provide relief to struggling borrowers who face adverse life events or are otherwise unable to earn high incomes. There have been problems with the implementation of IDR plans in the United States, but the problems are fixable, and some have been fixed by recent legislation, such as the Futures Act, which makes it easier for borrowers to recertify their income and remain enrolled in IDR programs. My research with Holger Miller shows that simple tweaks making enrollment easier can drastically increase take-up. Many countries, such as the UK and Australia, successfully operate IDR programs that are administered through their respective tax authorities, and these tend to work quite well. Beyond expanding access to IDR plans, there are also other policy options. One is expanding support for income share agreements, or ISAs. To my knowledge, these were first proposed by our very own Milton Friedman. Essentially, the way that these contracts work is that students pay a portion of their income, but unlike IDR, this is not capped by the value of a loan. This is similar to an equity contract. It's kind of like buying stock in a person's future earnings. The obvious advantage of ISAs, which is shared to some extent by income-driven repayment, is that these kinds of contracts provide insurance to borrowers. If income drops, the amount owed also drops. ISAs provide more insurance to borrowers, since if income drops, borrowers pay less and end up owing nothing. They also have more upside for investors. The concern with ISAs has to do with information asymmetries, in particular, adverse selection and moral hazard. So James Tobin, the Nobel laureate, and others such as Nerlov quickly pointed out that these information asymmetries could be a threat to the functioning of a private ISA system. The basic concern is that riskier borrowers selecting into ISA versus traditional debt. If you're Oprah or Ken Griffin, you probably want a debt contract rather than equity. If you plan on becoming a monk or traveling the world on a budget, you probably want to go with the ISA. Tobin essentially says this in this quote here, you can read it, but he also expresses some optimism. He went on to design an ISA plan at Yale. It was a complete disaster and was a major headache for the administration for many years. On the other hand, the credit environment was very different in those days. And today it's much easier to get information about borrowers and screen them. A number of companies and institutions today are successfully operating income share agreements. So companies like Stride in the United States or Alumni in Latin America are operating private ISAs, and Purdue University has been operating an ISA program for several years now. So these programs are still relatively new, so there remains some uncertainty about what happens long term, but the credit environment is very different from what it was in the 70s and 80s. Ultimately, whether ISAs are desirable depends on parameters relating both to information asymmetries and the insurance benefits that students receive from ISAs. But if information problems can be solved, then the potential insurance benefits are substantial. I'm currently doing some work on ISAs trying to measure these relevant parameters. While expanding the use of IDR plans and ISAs are an option to provide relief to struggling borrowers, there are numerous other options that policymakers can consider. One is reintroducing bankruptcy protection or a similar procedure for some borrowers. While IDR and ISAs can provide relief to borrowers over a long period of time, some borrowers may need more immediate relief. Today, this is extremely difficult. Student loan borrowers must prove a legal standard called undue hardship in order for their loans to be discharged. This is almost impossible to do in practice. And out of 45 million student loan borrowers, the number that successfully obtain this discharge each year is in the double digits. The reason why student loans have some bankruptcy restrictions actually makes some sense. The concern is that when students finish school, they typically have no assets. If they have no assets and significant loan burdens, then their net worth can be deeply negative, and they may have an incentive to file for bankruptcy. If they do this early enough, the bankruptcy will be expunged from their record. By the time they may want to apply for credit to purchase larger assets in their late 20s and early 30s. The way this worked prior to 1998 was perhaps a sensible compromise. Borrowers could not file for bankruptcy for 7 years following repayment. The idea was that right when borrowers graduate, they have no assets, but by 7 years later, borrowers who are doing well would have accumulated some wealth and paid down their debts, and those who still had negative net worths would be sympathetic candidates for some kind of bankruptcy protection. Prior to there being 7 years pre-bankruptcy discharge, borrowers had 5 years, so the number of years is somewhat arbitrary and could be changed by policymakers. It could also make sense to have some process separate from bankruptcy for student borrowers, given different circumstances for student borrowers relative to other types of consumers. This could be run out of the Department of Education or Treasury. I don't want to take a stance on exactly how this process should work or how generous it should be. The main thing I want to point out tonight is that there are a lot of other options beyond simply offering or not offering Chapter 7 bankruptcy in the same way as we do for credit card or auto debt. Policymakers could also directly try to solve incentive problems between schools and borrowers. As noted earlier, a small number of schools and programs are accounting for a large portion of adverse outcomes. To fix this, policymakers can make payments to schools contingent on outcomes. For example, Brazil has had similar problems with their student loan program and bad outcomes at for-profit schools. Recently, they gave schools skin in the game and required them to pay a fee based on dropout and default rates. This helps align the incentives of schools and borrowers. The Brazilian reform happened in 2018, so it's still early for us to observe long-term outcomes, but this may have helped improve some student outcomes. Making revenues go directly to schools from IDR plans or income share agreements where individuals pay an uncapped portion of their income could also help align the incentives of schools, students, and taxpayers. I do want to caution, though, that aligning incentives directly can be hard. The reason for that is we do not observe what we want to contract on, the value added from going to a school. On average, University of Chicago students earn more than University of Illinois students. And while I would like to think that this is all due to our superb teaching and resources, and no doubt much of it is, some of this gap is also due to the fact that Chicago is more selective and attracts students with stronger backgrounds. Estimating school and major specific returns remains a challenge, both in evaluating the returns on student loans and in terms of contracting to align incentives between schools and borrowers. This largely concludes what I wanted to say tonight. The main point that I want to make is that complicated problems need nuanced solutions. Not all of the answers to challenges in the student loan space are known, but we need more high quality research to help guide policymakers. We also need to educate the public and policymakers about the effects of policies that we do understand, because there are a number of misconceptions out there. Thanks for turning out virtually tonight, and I hope you all learned something from this talk. In particular, nuanced problems require nuanced policy solutions. I hope you retain at least 3 things. First, universal loan cancellation is regressive, and the benefits will disproportionately accrue to high-income individuals. Loan cancellation will also not be a lasting solution, as it will not fix underlying incentive problems, and we will likely be in the same boat in a few years' time, even if there is partial or even full loan forgiveness. Second, we can achieve significant loan forgiveness targeted in a progressive manner through expanding income-driven repayment. Many countries, such as the UK and Australia, successfully run such programs, and we can do it too. Third, there exist other policy options, such as income share agreements and giving schools skin in the game. We know less about these, but the potential benefits are large, and they are worthy of at least study and serious consideration. I hope that my contribution to this debate demonstrates the need for careful quantitative work to understand the consequences of forgiving student debt. Such work matters not only to predict the distributional effects of policies, but also incentive effects on student outcomes. Thank you again, and I'm looking forward to questions.
Great, thank you very much, Constantine. So the lecture, you can already tell, has two really great aspects to it. One is that there's tons of questions. And two, many of the questions actually you answered while after they were answered, you can see the questions. And so let me get to a few of them. There's Pete Miller and Peter Manda, both, and also Rodrigo, sorry, Rodrigo, let me get your last name. Rodrigo Guzman are all giving a bit more skeptical arguments of some of the arguments you give. So let me try to summarize some of them. One is, I think I'm most sympathetic to Rodrigo's point that at the end of the day, I totally agree with you that if you forgive student debt, that's not forgiving the cash flow payment, and therefore you're forgiving a lot of money that might not have a direct stimulative effect. But Rodrigo points out, I mean, the government has huge amounts of debt anyway, and it's not like, me as an individual paying a student loan is the same thing as the taxpayer who's going to pay, way into the future. And so there's an argument that student loan burden is higher than the burden that is average on federal debt. So that's one point that you can address. Another point is, I wanted to get your opinion on, I totally agree with you that this seems very regressive to just blanket forgive all student debt. Do you have a statement to make about more specific targeted forgiveness for, say, low-income borrowers? Or do you think income-driven repayment is already the best policy? Or do you think there's some sense in maybe, forgiving for people who make less than some amount, or forgiving 10,000 or whatever? So that's kind of related to one of Peter Manda's point, which is, there is potentially mental health burdens on people's opinions about where they can go, where they can move, what jobs to take. And then one of the questions that Pete Miller had, which I thought was fantastic, and I had the same question, although you answered it in part, is how do you think about take-up of income-driven repayment? And I know I've seen some research that suggests that it's quite poor, and that a lot of people that would benefit from IDR actually don't even take it up. And might debt forgiveness be an easier way in the sense that it just automatically happens? So I'll let you answer those three at first, and then maybe we'll have some more after that.
Yeah, absolutely. So the first question was about the stimulative effects of individual student loan payments or government debt. I mean, the truth is we just don't know which effect will dominate. It's true that federal debt is very large, and this is small relative to federal debt, but you can make the same argument and say that student loan forgiveness thus will be very small relative to GDP, and the effects won't be large. So the reason I'm very skeptical of student loan forgiveness having stimulative effects akin to, say, sending checks to people is because most of these forgiven payments will occur very far into the future, 10 or even 20 years into the future. So we can think of that as having a similar effect as, say, raising my taxes 10 or 20 years from now. Will that have large effects on spending today? Well, people have different views on this, but I think there's not strong evidence that would have very large stimulative effects. In terms of IDR versus some other kind of relief, so I'm very sympathetic to the point that some people might need some relief beyond IDR, which is at the end why I brought up some kind of procedure similar to bankruptcy. I mean, I think there are a lot of problems with simply making student loans dischargeable in bankruptcy, in part because I don't think the current bankruptcy system will do a good enough job providing relief to borrowers, given that it's very expensive to file for bankruptcy. And there's research showing that credit constraints can prevent many individuals from filing. So perhaps in addition to expanding and improving IDR and perhaps making IDR more generous, we do need some additional form of relief for borrowers who are really very low income, will likely remain low income, and aren't likely to be able to pay their debt and would benefit from having their debts discharged. So I would generally be supportive of some kind of relief program. But the key is we should have a permanent relief program, because if we go and forgive $10,000 or $50,000 tomorrow and then leave the system as is, what about borrowers who accumulate debts 5 years from now? Are we just going to rely on the goodwill of politicians to forgive debt balances every couple of years? No, we need permanent solutions and procedures. So that brings me to the final question of the first round, which is about low take-up of IDR, and that's completely true. Modern IDR programs were launched in the late 2000s, and initially take-up was very low. So take-up has been rising steadily over the past years. So prior to the beginning of the COVID pandemic, and during the COVID pandemic, there's been a moratorium on most student loan payments. So the numbers get a little bit strange after that. But prior to that, about a third of borrowers and well over half of balances were in income-driven repayment programs. So part of the reason why more borrowers were not in IDR was actually that a lot of borrowers signed up and were getting kicked off of IDR because the recertification process was difficult. So to some extent, that was fixed in 2019 by the Futures Act, which created a direct link between the Department of Education and the IRS, which will no longer require borrowers to complete cumbersome paperwork to stay enrolled in income-driven repayment. So another option that we have, which is the way that student loan programs are run in Australia and the UK, is just to have all borrowers in IDR and have the US Treasury and the IRS administer payments. So that works reasonably well in the UK and Australia, and it would solve this problem of low take-up and also eliminate many of the other negative consequences of default.
That's closely related to another. Let me ask you maybe two final questions. If we have about 4 to 5 minutes, and then we'll wrap up. Ann Garcia is saying something that I have a lot of sympathy for, which is related to this, which is why do things, I'm paraphrasing Ann's question here, why do things have to be so complicated, right? I mean, why not try to make it simple in terms of what program to get into, how to make it easy to automatically get IDR, income-driven repayment. Do you think that quantitatively could make a big difference? And maybe as you're answering that, I'd love to know not just the total amount of balance and the total amount of people doing IDR, but also what fraction of the people eligible, right? So that's a good question to answer. And then maybe we'll wrap up with, and I apologize to those of you, there's so many great questions, but we're running out of time. From Alex Barnett, which you touched on, which Alex was asking, is there room for private market solutions? And then you actually put up the slide with some private market solutions. So you partially answered this, but I know, if I remember right, I think you were doing some research in other countries and whatnot with people thinking of clever ways of trying to do student debt that may be more equity-based, maybe more income sharing. And so again, those will probably be the final two questions we have time for: simplicity and also private market solutions. And again, I apologize to all of you that were unable to get your questions answered, but such is the nature of a great talk where there's lots of questions.
So first, why is this complicated? I mean, the short answer is you'll have to ask the politicians and the bureaucrats. So the more serious answer in terms of IDR is why are there so many overlapping plans that basically do the same thing, is it has to do with legal reasons. The plans are written into the promissory notes of borrowers. So once you have a plan, even if it's worse than a new plan, you can't legally get rid of it in many cases, and this just leads to endless complexity. I think other reasons are just political gridlock. I've talked to a fair number of policymakers on both sides of the political aisle, and it's surprising how much agreement you have for small technical fixes, and then it takes several years just for anything to get done, because people are looking to pass these very big sweeping bills, and there will be disagreements about some things, and that prevents small technocratic fixes that can be very important from actually getting done. And I think there's a very strong evidence that eliminating paperwork and these bureaucratic hassles can lead to big increases in enrollment. So, for example, my paper with Holger finds that just using an automated process and eliminating paperwork leads to a 2.5 times increase in enrollment in IDR. So today, the numbers for balances and number of borrowers in IDR are very close to the number of eligible borrowers, because, so for more recent plans, almost everybody is eligible. That wasn't the case in the past. So in terms of private sector solutions, it's hard to say. A lot of these companies are offering income share agreements, which may have benefits for many borrowers by providing more insurance. We don't see very many private student loans, and I think that's an important question that we don't know the answer to. So is it because this market just can't function because it's so hard for lenders to get information about borrowers, or are government programs, which may be less efficient, just crowding out private sector programs? I think that's an important question, and I think we don't know the answer to it yet.
Great. Well, I think we're out of time, but thanks a lot, Constantine.
Oh, thanks everyone for coming. This was a lot of fun and a real pleasure.
Hi, yeah, thank you so much for sharing your work with us, Professor Yannelis. This is really fascinating, and thank you, Professor Sufi, for being here to extend the conversation with our audience. So thank you again for joining us. Have a wonderful summer, and we will see you again in the fall.